All right, thanks for joining us today, everyone, in our first podcast of the year. I hope everyone had a wonderful holiday season. We've gotten past our first snowstorm of the year. Hopefully it's our last snowstorm of the year. And I wanted to jump in today, and thanks, Jay and Cody, for joining me, and talk a little bit about something that's reared its ugly head here in 2022, and that is volatility. We've gone quite a few months, in fact, over a year, without really any significant volatility in the market. And I know we've had some conversations with clients, so I wanted you guys to join me today. And we're going to have a little conversation about it. Let's first start with Jay. I'm going to start with you. Talk to me why about the volatility so far this year.
There are several factors that are happening right now. One of the big ones that we haven't seen in a long time as far as creating volatility is going to be inflation. We haven't really seen high inflation for a long time. And then I believe December's 12-month volatility number, inflation number was 7%. Ooh. So we haven't seen anything like that in decades, actually. So that's one of the big ones. In response to high inflation, obviously the Fed is going to want to do something about that. So that's really their primary job, right, is to stabilize the market and everything. So their response would be to raise interest rates, stop with the quantitative easing, those sorts of things. So the market's watching that closely as well.
Yeah. So, I mean, it's not transitory?
Ooh.
On that note, Cody, there's other issues. Jay's right. Inflation's a huge one in the Fed's response, but there's other geopolitical, other economic issues that cause market volatility. Why don't you share with us a little bit of what you see there?
Yeah, I mean, a lot of it is from, it's kind of 2021 all over again when we talk about supply chain issues. And we still don't think that's going to go away for probably another year or two. It's just hard to say on the demand, but the demand's still high for people, for services and goods. But this year we kind of have a little different formula in there with, I would say, more geopolitical issues being, you're probably hearing about Russia and Ukraine in the news. If something does happen with that, it's no one knows, but there's a little uncertainty that goes in the air, which the markets don't like uncertainty. And there's also issues with, China and Taiwan. They kind of been going back and forth, and, that's been going on for, 5-6 years that I've been kind of paying attention to it, but it seems like it's a little bit more tense this time. So, if one or two of those go on at the same time, I think there will certainly be some short-term volatility. And, what impact is the U.S. going to have? The White House has already said that we would have troops over in Ukraine. So, no one likes a war, and we'll have to see how that folds out. So that certainly will cause some short-term interaction in the market, which we have seen. Right. We are in correction territory technically, or we were in it, and we kind of bounced back out of it. But correction being 10% from the high, down 10% from the high. With what happens, and all this ties into supply chain issues, tie into inflation, which inflation ties into the interest rate. So it's kind of it's a circle.
A vicious cycle.
It's a vicious cycle. Yeah.
All right. So short-term volatility, right? We know that it's up and down. Long-term drivers in the market. Inflation's not short-term. It's not transitory. Let's start with you, Jay. What levers or what's the Fed doing to watch this? This is more of at least an intermediate problem that could have some impact on the market. What are you seeing there?
Right. So the Fed has really outlined here are the factors that we're looking at to decide if and when we're going to start making movements back towards interest rates increasing. So looking at this nice thing that Cetera put together for us, you can see blue's kind of cold, and then red is getting hotter, or maybe the Fed needs to make some changes. And so it's really easy to see in the last 12 months how it's shifted from almost everything across the board is blue to almost everything across the board is red. So easy indicator there to show, hey, everything that the Fed's, not everything, most of the things that the Fed have said, those targets are being hit. So interestingly enough, if you look at the market, just 6 months ago, back in August, if you look at the small numbers there across the light blue, we didn't really think the market, I should say, didn't really price in any type of rate adjustments for 2022. There was just not a lot going on, didn't feel like it was needed or necessary. Fast forward, and now in February, you can see as of by the end of the year, the market's priced in 5 rate increases of 0.25% each time. So now the market is looking at it. Now we know inflation has reared its ugly head. And now everybody expects, not only thinks it's possible, but expects the Fed to make some rate hikes.
So real quick, so the Fed's heat map is red.
Yeah.
They're on the case. Market's priced in potentially 5 rate hikes. Just quick question. We're in an election cycle. How likely is that?
That's a great question. So when I say the market expects it, that means if it happens, there will probably be short-term volatility and it'll be fine. So how many? Nobody knows that. I still kind of feel like we're going to get maybe 2 to 3. 5 I feel like is high, but we'll see. I think the market could use 5.
Yeah, the fallout from that might impact an election, which is why you might not get 5.
Right. So they're going to tread lightly when it comes to any heavy-handed anything.
Sure. Okay, good. So that's the Fed. Now let's go back, Cody, to broader economic issues, which we know long-term drive sustained movement one way or the other in the market. What are you seeing in terms of those economic factors today, and what are the possibilities throughout this year?
Yeah, so, kind of a recap from 2021 to looking forward. 2021, it was actually a great year in terms of GDP, up 6.9%, so almost basically keeping pace with inflation, which is what you want to see in these times of markets. I think big factors is that, I think we'll continue to grow, but I think the pace is going to slow down. And that's exactly what we're seeing right now. So there's kind of 10 indicators that we look at on judging recession and judging the trends of the economy. And, out of those 10, there's 8 that they're going either flatlining or negative. Not that GDP is negative, but the growth acceleration of that is not as high as it was, which we would expect. Or the U.S. is too big of an economy to have multiple years of growing at 7%. And going back to the risk of recession, we're not really seeing it out there. People talk about bubbles. There's usually a lot easier to look at a bubble in the rearview mirror, but we're not seeing anything as far as debt and budget sheet goes or balance sheets go for companies. Everything looks pretty good right now. And earnings is obviously a big driver of what happens in the market, and then that correlates into the economy. And earnings so far that have come out, that are coming out now for fourth quarter of 2021, they are meeting or exceeding the expectations of it. And I expect that to go out through the rest of the year, which will hopefully lead to a positive market year when we look at December 31st of this year.
Cool. Yes. So, all right. So that helps a lot. So, the volatility, it doesn't feel good. It stinks. There's another term I could use for it. We haven't had it for a while. We talked about kind of the why, a lot of different things going on. I think the good news is that the Fed's on the case, but it's priced into the market. The economic factors, it's not a disaster. We're not teetering on the edge of a recession. Mm-hmm. It's a mixed bag at this point. So as we look forward, maybe in terms of getting it down to an individual's level when they look at their overall investment portfolio, Jake, give us a little bit of perspective in terms of what someone's supposed to do with all this information.
Sure, and this goes back to something that we all talk to our clients about, and that's diversification, right? Mm-hmm. And so not only across stocks, but adding in bonds as well. We don't want any of our clients 100% stocks. But even if they were, for example, volatility is normal. It's just part of the market cycle. It's just part of growth. Stock market's not ever going to only go up. We'll have some down times too, right? So for some perspective, if we look back just 2 years ago, you can see that, volatility, even in every year, is normal. We're going to have down points within the year, just like right now. You can see back in 2020 went down 34%, the S&P. However, you can see it ended the year at positive 16%. So that's pretty big extreme example.
It's a roller coaster.
But just another example. But if you add in some bonds to that, we didn't get near that negative 34. It only went down 21%. So 21% down still didn't feel good, but it was a heck of a lot better than seeing down 34%. And on the flip side, by the end of the year, it was a positive 14%. So 2% difference for adding in a lot more cushion in there using bonds. So that's why we never want anybody to be 100% stock. That roller coaster is just way too steep and way too aggressive. And you're really going to be rewarded emotionally if you don't have to worry about those extremes by adding in some diversification in our portfolio. So moral of the story, volatility is fine. It's normal. Yes, we're down right now, but, that doesn't mean that's where we're going to end up in December.
Right. And I think that the great part about that perspective is it's times like these, which is why we want a diversified portfolio in a variety of different stock type investments, bond type investments. We haven't really had it the last, say, 18 months. We're having it now, and we're actually seeing the results, the positive results that being diversified, what that can bring.
Right.
Okay. All right, fellas, great way to kick off the year. I appreciate your insights. Thanks everybody for joining us. If you got any questions, please pick up the phone and call the old-fashioned way. Use our text line. Use an email. Happy to answer any questions, any more detail on this information or anything that relates to your portfolio. And here's to no more winter weather for the rest of the year.